my friends. Chris Marcus here with you for another episode of Inside the Markets on the StockPulse network. And before we get started, go ahead and hit that subscribe button because as you're about to find out, I have a great guest on the show today that I'm looking forward to catching up with for the first time. And that is Michael Oliver of OliverMSA. And Michael's been doing a lot of great research for a while. And in particular, one of the things that I've found fascinating about your background, Michael, is that you get the fundamentals, you understand what's going on with gold, yet also do a lot of technical analysis, which I think is something that's helpful for people to really get an idea of how to integrate the two. So with that said, welcome to the show, Michael. How are you doing today, my friend?
Good to be here. Thanks, Chris.
Yeah, so maybe to get started, I was watching that interview on Real Vision TV, and you have a great, fascinating background of how you got into all this. So maybe just a little bit about that and how you got started, and then we can hop into the markets.
Well, let's see. In the mid-'70s, I was working toward an academic career in political philosophy. I was of a libertarian bent. And you can imagine that wouldn't go anywhere if I had gotten my PhD. And that was in 1974 when the great drop in the stock market occurred, and there was a deep recession. In fact, even tenures weren't being recognized in certain universities. And so I said, enough with this. So I quit in the middle of PhD work and joined E.F. Hutton, commodity division in New York City, as a gold specialist. And I worked under, fortunate enough, sheer accident, but the head of the department was David Johnston, who was also chairman of the COMEX. And that's when gold was legalized a few months prior to when I got hired in January of 75. And I worked there for a year and a half and then went out and became a retail futures broker. But in working in New York, I got to be around the pits, the COMEX, which then was not in the World Trade Center. It was on Broad Street in its own building. And it was all hand outcry, the whole deal. And had guys, young kids going up ladders and putting on chalkboard the prices that are being traded in the pit.
Yep.
Boy, those are the old days. So even before Trading Places, the movie.
Yep.
Anyway, so it was an interesting background, totally futures oriented, and on the commodity side only. And but in 1992, been in business since 75. So I shifted out of brokerage into research. But not just technical research, not the normal price chart orthodoxy. We've had that around since Edwards and McGee wrote the book, Technical Analysis of Stock Trends, about 70 years ago. And that's been the orthodoxy since then in terms of what is technical analysis. The problem is that price is not a good measuring metric for technical analysis, and nor is it a good metric for fundamental analysis. Because when you measure things by dollar units or euro units or yen units, price of a share, what are the corporate earnings, what are the year-over-year sales increases of the company measured in dollars. Well, if you look at a chart of M2, go back to the 1950s, it's increased 4,600%. The chart is parabolic. And it virtually doubles. It's 90 some odd percent. Every 10 years, the quantity of money doubles. Right. Well, what does that mean? I mean, you get a yardstick that says 36 inches, but 10 years later, it still says 36 inches, but in fact, it's changed dramatically. So that what you measure versus 5 years ago or 3 years ago or 10 years ago is not really objectively being defined by your unit of measure. So how do we get away from that? You can't, not totally. But what we do is we measure markets against a mean. Bob Farrell, famous Merrill Lynch technician, his top rule of investing was markets tend to return to the mean. Well, they also tend to oscillate the mean, go above and below. And by mean, we mean moving averages of various timescales, short-term 10-day averages up to 3-year averages, let's say. Well, we measure versus the average, and the average is a function, not just, it's a function of the movement of the underlying market in relation to price. So to some extent, we've distanced ourselves from the price scale on the left, and we've turned it into an oscillator scale, which is determined by the movement of the market and the movement of the average. Right. So we get a different picture of the technical trend of a market when we look at a momentum oscillator. It may agree with or disagree with what you see on the price chart. Usually, before a trend changes, top to bottom, bottom to top, momentum will break out first, almost always, in which case you get an early warning of a trend change about to occur, preferably on a larger time scale, not week to week. And it gives you an edge over the guys who are looking at price charts for a trend breakdown. They might be 20% off a stock market high before they realize it's over. We're now major bearish on the stock market, on the developed economy stock markets, major bearish. We think the top is in place. The only issue is the nature of the decline. Is it a zigzaggy process? Remember 2000? It didn't just collapse. By the time you made your top in March and then again in August of 2000, it was 2001. You were still rallying back up, trying to get back up off the ground. And then it wasn't until mid-2000, 2001, they really started to break. Same thing happened in 2007 top. Topped in October, came down, made a low in January of 2008, rallied all the way back up into May 2008, almost back unchanged on the year. It was only then you finally started to fall apart.
Right.
So those were arduous tops. In other words, they weren't clean, crisp collapses. And the question is, are we in for that type of action this time? Or are we in for something more rapid? And MSA, Momentum Structural Analysis, originally thought that once the top was in, and we think it's in, that it was going to be another arduous top where you would be fooled by counter trend rallies that took your head off, like we're getting today on the Powell speech. We tend to think it might not be this time, that there might be a rollover more rapidly in the certain key levels below the markets, and it's not the February low, that 2550 area. It's there's a level around 2400 on the S&P. If you don't hold it, you could just crash right on through. So our pivotal level is not holding above or below that February mini crash low, 2550.
Right.
It's down about 6% below there. If you don't hold that level, then we could define whether this is going to be something rapid or something arduous. But a top it is, as far as we're concerned.
Right. So it's interesting you mentioned that, and one of the things that's popping to my head that I'd love to hear what you saw back then, you mentioned 2008, and again, you're right, it wasn't all at once, although there were periods where things did collapse significantly. What kind of indicators were you seeing back then? Were you able to see how the big moves eventually did come? And then along with that, are you seeing any of those now that would indicate that something similar is on the way?
Well, what we're looking at when we define a major top in the stock market or any market is not month to month or week to week action, and especially not price charts, but we measure, for example, monthly bar chart in relation to, let's say, a 3-year moving average or a 3-quarter moving average, something of fairly long duration, of a yardstick. And then we plot the oscillator and we see structures develop, just like you would if you look at a price chart. You might see an uptrend line or you might see a flat floor. Well, the same things develop on momentum, but usually clearer and more evident to the eye. And as far as we're concerned, there's been enough breakage in the major developed markets, Nikkei, European markets, our market, to indicate the top is in place. Now, there are, especially in our market, which has been stronger than those other developed markets on a percentage basis, there's still a few minor levels below that if you break them, then we go 100%. We're convinced it's all over. You're really going down. But we're pretty much in that, at that point now.
Right.
So we treat rallies like this as so much hot air, and they're likely not to hold for long. But it's a measurement process. We don't take fundamentals. We don't look like what's a GDP or what are earnings doing, that kind of stuff. Those might be helpful at some point in time, usually well after the top. Right. We look at the momentum structures, just like you would look at a price chart for structure, something to break. And if you've broken it on momentum and it's on a large enough time scale, annual momentum, quarterly momentum, then you've got something potent. And again, we're at that point. So I think the potent stuff is spoken. Now, on the other hand, there's 4 asset categories out there. There's debt, foreign exchange, and commodities. And in particular, we're watching gold because we think it's going to be on the opposite side of this equation.
Right.
We think the bond market, we called the top there in October 2016. Bond futures are trading at 166. They're now in the 130s. We think they're going into the 120s. But there could be a sharp counter trend rally if there's a sufficient flight to safety due to a sharp next drop in the stock market. You could always get that, so you have to be aware. While we're bearish on bonds, meaning higher rates, we also are aware of the potential. And anyway, but in the commodity arena, we've had some big up moves in the past 2 years off of deep lows in crude oil
Mhm.
copper, for example, two commodities that are closely linked to the economy as such. Dr. Ed Yardeni calls copper Mr. Professor Copper. Has a degree in economics. Well, copper and oil have both had big hits over the last several months.
Yep.
It upsets some stock people, and it probably should. But they had a huge percentage gain off their bare lows, whereas food commodities didn't, like grains, meats,
Mhm.
sugar, so forth. That's where we think in the commodity sector, there could be a large percentage gain in this move that's opposite stocks. We think they're overdue. They've come to effectively theoretical zero, you could call it. Corn's not going to zero. Go to $3, but it's not going to go to zero. And it's laid there for 3 or 4 years. And same with soybeans, same with wheat, although wheat started to move. But as far as the precious metals go, we think that silver and gold and the gold miners are a place to be. I think gold is literally, right now, it's trading 12-20 area. 1.5% above where you are right now, and I don't want to get too specific because our subscribers pay for this information.
Right.
We think gold could launch big time, meaning the congestion zone that we've seen in the price of gold with all these highs, 2015, 16, 17, and 18, up in the high 1300s, could get taken out rapidly. And we think the tipping point is not to get up there and take it out, but is far lower than what the price charts indicate.
Right.
So a price chart of gold right now, you get salivate if you saw it go through 1360.
Yep.
We're saying there's a number far below there that says you're going through there, and it's a momentum-based number. And we don't think the gold upturn out of this congestion, which has been well above the bear low. You got to remember the bear low was 1046 or 1220. We think the move up out of this couple years of twisting and turning should not be slow and arduous. It should be rapid so that those who are not positioned long will miss it. Those longs who've been fatigued and have exited some of their position should miss getting back in, and the shorts should be ambushed.
So there's hope for us who have been sitting around waiting for years for the move to come.
I think that if it's going to go up, it's going to go up so rapidly, it'll be a matter of weeks. You'll overcome a lot of turf rapidly, and then you'll be on the other side of that 1360 level where everybody says, aha, it's a bull market. It's a bull market already.
Right. Which leads into my next question. I've been really wanting to get your take on, where I'm sure you've heard there are a lot of folks that believe there's some manipulative behavior with the COMEX futures contracts. I started getting into gold back in about 2009. And what really made me start digging deeper into that was, I remember in September of 2011, gold had hit $1,900 in the middle of the night. The Swiss say they're going to peg to the euro. And then we saw gold get torched in the middle of the night. Again, as a former equity options trader, I feel like I would have been thrown out of my shop that afternoon if I had hammered a big block offer in the middle of the night. And sure enough, some of the banks have now been getting fined or pleading guilty to manipulation.
Oh.
So curious your take on that, whether that's, because I wonder if all this paper that's out there can be delivered. So curious your take on that and how you reconcile that with the technicals, because it makes it quite a lot of moving pieces. So it's great to get your opinion on that.
I think that those type of events, let's assume they happen. Okay,
Yep.
It's a fair assumption, and people who got big positions think they can move things, right? Central banks do it all the time. That's what they're in business for, to manipulate prices arbitrarily.
Yep.
So we know they manipulate things.
Right.
Why not other big banks that are maybe connected to central banks? But I don't think in the long run it makes a difference. And for example, during the bull market in gold, from its August 1976 low at $103 up to its 800 plus high in 1980, the IMF was selling gold in big blocks.
Right.
And they would come in ambush style and try to hit the gold market. You could tell they were trying to hit it at right spots. It didn't work.
Mm-hmm.
It failed. Ultimately, the market just ate them alive. And I think they actually quit ahead of time. So I'm not concerned about that. The issues at hand here are far bigger than somebody playing a game, even if they're a big player.
Yeah.
In fact, if they try to play a game too long, they'll get eaten up by their own gameplay because the market will kill them.
Yep.
Remember Bunker Hunt, $50 silver back in 1980, and he said it's going to 100 in an interview in Commodity Magazine. Well, he was the king of silver, right?
Yeah.
Okay. Well, he got killed. because it collapsed from 50 down to about in the teens in a couple of years, or a year or so. And he got the first $20 off that high. He basically couldn't sell. It came, so anyway, that doesn't impress me. In fact, when I hear this and I think about who is that's trying to manipulate, usually they become a victim.
Yeah.
And that's the justice in the markets.
Yeah, which has been my take as well. Again, a lot of people have focused on JP Morgan, which one of their guys did plead guilty, although kind of like you mentioned, I keep thinking back to their big whale, the big London whale trade or whatever the guy was called back in 2011 that had that massive position on the credit index. And if you do things and there's always a point where it's too big and then the market reasserts itself. So it sounds like you feel that, they can do whatever they do, but still based on all of it, that, it is going to resolve. And
the fundamental now that we've got is across all markets. And it's that we know that in the last, since the Fed was founded, back in the 20s or whatever, that it comes in, it intervenes in markets, and it does what? It manipulates the price of a market, whether it's the cost of money or the quantity of money, whatever. Arbitrarily, without market forces being involved. It manipulates it because it's wiser. It knows where it ought to be, what's going to bring good, right? Okay. Well, that process, the boom-bust cycle that's associated with that, and it is associated with central bank actions, I argue. And a lot of people have come to recognize that. For instance, Greenspan pulled out all of his guns in 98 when we had the stock market drop and we had the Thai bot crisis and the Russian thing. Okay. It helped take the .com bull market at that point into a bubble status, because when they allocated the money and created the liquidity, investors then allocated it where they thought it was best to be. And that was obviously .com. And so they took .com off the page, which overdid it. But that was a brief intervention, if you think about it. It was months, quarters, not years, to generate that boom-bust spike.
Right.
Similarly, the real estate bubble. It was a couple of years, but we've had a bubble going on here, arguably for 10 years, certainly for 7 or 8 years, of a nature that nobody would have conceived of 10, 20 years ago. Namely, zero interest rates, negative interest rates, or rates so close to zero it doesn't matter. We were sort of on that end, and the Japanese were on the negative, and the Europe on the zero. But these are off the page crazy. But it wasn't just crazy, but it was crazy for a lot of years.
Yeah.
What that means is that the information provided to investors, to corporations, even to governments, is false information for them to base decisions on, like investment commitments, borrowing money in the bond market, whatever. Of the price of money is artificially low. They don't have a true metric of where is reality, because reality is not there. It's been denied to them. Well, when you do that for 6 months, you get a distortion. You do it for 6, 7, 8 years, you've created so many bubbles within the bubble that it's uncountable. And therefore, when it comes undone, it is likely to come undone in a way that will hit many asset categories in different ways and come back to the central banks this time. Why? Because they've taken credit this time. We are the heroes. We saved you from the great 2008 debacle. No, they didn't. They postponed it, and they made it worse.
Absolutely.
So when this comes undone, there's a chaos theory, and we deal with markets, you and I, on an incremental basis most of the time, where you see it go up and down a staircase, incrementally, in other words. But there's times when markets just go berserk. And I have a sense that this one, in all 4 asset categories, is going to go berserk at some point, where the violence in the markets is so horrific that the central banks are literally knocked off their podiums and not sure what to do. In fact, they don't have much ammunition left anyway. So it's going to be fun.
Yeah, I think you're spot on there, Michael, because especially ever since we were introduced to quantitative easing, a lot of the Austrians, and I came to agree with that view, where maybe this is the time where the central banks, people realize what they've been doing, how this system works, and they're finally put out to pasture. Especially because if Paul Volcker had to raise interest rates to 20% back in 1980, and even when Greenspan was raising rates following 1 year of 1% rates, his last hike was up to 5.25% in 2006, and yet here Trump or Powell is gotten up to 2.25%. 10 years later, and Trump thinks it's going too fast. Makes you wonder really how that will play out. And Perhaps the last question before we let you run today. I'd love to get your take on silver and your thoughts on the cryptos. Obviously, maybe people are more focused on the cryptos than silver today, although both things that I'm looking at, and curious what your take is on those.
Okay, on the silver, we think that silver will outperform gold ultimately in this bull market. Not at the present time. It's still in the congested phase. Silver pulled all the way back to test its lows. Gold is nowhere near back testing its lows at 1046.
Right.
We think silver's a theoretical zero. Again, that concept, you can't go to zero, but over time, what might be zero in one decade is higher the next due to the simple money supply increase. Okay.
Right.
We think silver will outperform gold. And we're on top of that issue, and we're monitoring for breakouts in that spread so that we can then say it's happening now. Right now, it's not happening. It could happen suddenly. What was the other market you want to talk about?
The cryptos.
Oh, the crypto. Oh, I love it. Before the cryptos came out, Bitcoin futures on the CME, we put out a report, and the Wall Street Journal picked us up on this and covered what we said. This is November of 2017, before they started trading in December. We said once they become a futures contract, they will peak.
Right.
And they will collapse from their 20,000 level to 5,000.
Yep.
Okay, well, they collapsed from the 20,000 level. They didn't go to 5,000. They went to under 6,000, and they oscillated for a whole year, 3/4 of a year, with lows just under 6, just above 6, back and forth, a big flat floor on the price chart. Everybody thought that's the bottom. We said, nope, you're at least going to 5,000, maybe lower. Not interested until it blows that price chart floor out, because too many suckers are looking at the price chart thinking, look, it's held this time 5 times at this level. It must be a buy. No, it's not. They blew it out now. We've gone into the 3,000s, I think. Yep. We have numbers above the market that come down constantly based on certain long-term moving averages and structures on the momentum charts based on those averages that say when the next upturn comes, we will time a breakout that says, okay, that was the low you made, whether it's 3,000 something or whatever. We'll get an upturn, and when we cross those structures, we'll put out a buy signal on Bitcoin. Right now, it's not a nearby issue. I'd say come back next year, January, February, take a look again. We'll update when we get near a buy breakout structure. Right now, we're finishing the flush. I don't think it's going to go to zero, but it's going to go lower than everybody thinks it's going to go, and it already has. Yep. But it's satisfied what we wanted. Namely, you've got to get at least to 5,000, which is 75% off that high, and you got to make people down, and I think they feel down. I also think that a lot of people investing in Bitcoin aren't experienced traders. There are a lot of young people that, to them, this is a gold mine they just discovered, and they're investors. And they don't know how bear market lows are often made, and they're painful. They're not simple. Yep. And I think that's what we're going through.
Yeah, well, Michael, I appreciate everything you shared. You have a great handle on the markets, and again, putting things together for myself and the other folks out there of how to integrate some of the fundamentals and the technicals. So really appreciate you being on here, and perhaps just in wrapping up, let folks know where they can find you. So people are out there seeing the stock market plummet, cryptos go nuts, wondering about gold and silver. If they'd like a little more assistance or to get involved, where can they reach you at?
OliverMSA.com. Thanks, Chris.
All right. Well, I appreciate that, and we'll look forward to checking in with you again soon.